to start there. All right, we're on page 271. Question 1. Which type of legal instruments may legally be prepared by a licensed real estate broker? What's your answer? You got C? Yeah, because look at the other ones. Can't prepare a deed, can't prepare a promissory note. And then the last one is mortgages, promissory notes, definitely not. So it is C as in Charlie. All right, let's move on. Number 2, failure to comply with the statute of frauds. What's your answer? It is B. Would have to do with whether the contract is in writing. And that's what the statute of frauds requirement is all about. Contracts transferring ownership rights in real property. Contracts that are not to be completed within 1 year of the date created must be in writing and signed to enforce them in the court of law. That's what the statute of frauds is all about. Which contract for that same subject does not come under the jurisdiction of the statute of frauds? Say because of the time period of that lease, right? If it was over 1 year, would have to meet the statute of frauds requirement, therefore be in writing and signed to enforce in the court of law. A valid real estate sale contract, what'd you get? Longest answer contains all of the essentials and is in writing. Think of the acronym COLIC. This will help you remember. Competent parties, offer and acceptance, legal purpose, in writing and signed. That's the statute of frauds requirement. And consideration. There are 2 types of consideration. We'll have a question about that in just a moment. Number 5, an adult contracting with a minor is an example of failure to meet which essential of a real estate contract? Of course, is D, competent parties, dealing with individuals of sound mind and of legal age. Unilateral. 6, canceling a daughter's property debt in a contract due to love and affection is an example of? Yeah, good consideration. Keywords love and affection. Number 7, a contract that is not in writing is called? Parole, verbal, informal. All mean the same thing, that it's not in writing. Number 8, when a contract has been formed but an undertaking remains to be performed by one or both parties, this is an example of? Executory. It's basically saying when a contract has not been completed yet. When a contract has been completed, it's known as being executed. Know the difference. 9, which statement is false regarding counter offers? It is D. The offer or and the offeree remain the same even though the terms are modified? No. Person giving is the offer or, person receiving is the offeree. And as we make counter offers to one another, we change roles, positions within the negotiation process. 10, an offer is not terminated by an extension. D is in Delta. 11, closing schedule for next week. The broker would like the closing agent to prepare a check payable to the associate for their share of commission. Which statement is true? It is D as in Delta. The broker must provide specific written instructions to the closing agent regarding the amount of compensation to be credited or to be given to the associate. 12, a woman gave an exclusive right of sale listing to a broker to find a buyer for her residential lot. While she was vacationing with her family, a buyer signed an offer to purchase the woman's lot at the full price in terms of the listing agreement. Which statement is true? Exactly. The exclusive right to sell listing does not give the woman the authority or the agent to accept the offer on the woman's behalf. But what legal document would give somebody authority to handle legal matters on another's behalf?
It's
Power of
Power
attorney.
of attorney document, which we didn't see here. I'm just reviewing with you guys. 13, a man and a woman enter into a written agreement. The man is obviously going to mow the woman's lawn every week during the mowing season, every 3rd week during the winter. And he can't catch a break. He breaks his back. The man breaks his back doing manual labor. That's why they call it manual labor. And he hands over his maintenance contracts to a friend who assumes responsibility for all the man's customers for the remainder of the contract period. What term describes this arrangement? It's assignment. And the document that must be signed to solidify assignment is called novation. 14, which applies to exclusive right of sale listing? All of the above, more than 70% of the time. In this case, it works. 15, which disclosure regarding radon is required when purchasing or leasing real property in Florida? Yeah, simply put, just a disclosure statement in the contract explaining radon gas. And you fulfill that requirement for disclosure. 16, a real estate sales associate must disclose to a prospective buyer, C, that the family room addition does not comply with local building codes. 17, normally a sale contract involving real property contains a provision that in case of breach by the buyer, the earnest money deposit will be regarded as, in this case too, the seller, because the buyer breached. If the injured party claims the deposit and the deposit only, that's liquidated damages. If the injured party tries to claim anything beyond the deposit, now we're talking about compensatory damages. That's how you figure out the difference for your exams. 18, the most advantageous type of listing from the broker's point of view is the C, exclusive right to sell. 19, which statement is false concerning Florida's building code violation disclosure? Yes, it is A. That's false. 20, a couple have decided to make a written offer to purchase a home built in the 1950s, which task is not required before signing the sale contract. Correct answer is C. Yeah, that they have to have the home inspected for lead-based paint now. Good job. Let's move on. Any questions? No. Let's move on. Unit 12 was an introduction of financing. We're going to start on page 293. Question 1. In a mortgage transaction in Florida, the legal evidence of personal debt is the note, promissory note. You got it. Mortgage note, even sometimes called a bond, must accompany all mortgages in Florida. You can't have one without the other. A type of seller financing in which the seller retains legal title until the buyer has repaid the debt is the contract for deed. You got it. C as in Charlie. Number 3, in title theory states, which Florida is not, the mortgage clause that provides that the conveyance, transfer of title to the lender is defeated, keyword, when all the terms of the agreement have been fulfilled is the defeasance clause. Good job. Number 4, a home was purchased with a down payment of $50,000, loan of $200,000, 6% interest, 20 years. Monthly payment does not matter because they're asking us for the LTV. Loan to value ratio. And if you can recall, the formula, it's on your handout as well. You take the loan and you divide it by the value and you get the loan to value ratio. So let's plug in the loan, which we know is 200K, right? And you divide it by the purchase price or value. They tell us, not directly, but they give us enough information. If you financed 200 and you contributed 50,000 of your own money, you add those two figures together and you get the total purchase price of 250K. And that's going to give you 0.8, which is 80% LTV. And that lines up with letter D. Any questions? All right, moving on. 5, a borrower who is in default on a mortgage is allowed to prevent the lender from foreclosing on the property by paying the mortgagee, which is the lender, the delinquent principal and interest plus any expenses that the lender has accumulated in trying to collect these payments. This right is called equity of redemption. C as in Charlie. Keyword redemption, you're redeeming yourself. 6, a lender declares all the unpaid balance due and payable as a result of default. The lender is exercising the A, acceleration clause, which probably don't like. There's a clause that goes hand in hand with this that allows you to get back on track. If they accelerated and they're asking you for the remaining balance, what clause allows you to get back on track? That's when you're in foreclosure. When the acceleration clause has been initiated, what is it?
No.
They include it as one of your answers. The right to reinstate clause. Number 7, the person who borrows money to help pay for purchase of real property is called at various times the mortgagor is the borrower who's always or. And the mortgagee has the money. You got it. 8, when a vendee buys subject to the mortgage, it's D. The vendee is not responsible because the subject to the original borrower is still in place. 9, a couple has just made their final mortgage payment on their home. What document must a lender file on their behalf? Within how many days? 60 days for satisfaction of mortgage. And they will then remove that mortgage lien. 10, if the lender does not want the mortgage to be paid ahead of schedule, the lender will impose a prepayment penalty. A is an alpha. Number 11, a buyer agrees to purchase a property with an existing mortgage lien, in which situation is the new buyer the only party responsible for the debt. Assumption with novation. So they're describing assumption, but novation must be signed to solidify or substitute a new borrower for the original in place of the original borrower. 17, the LTV is 80%. A buyer wants to acquire a property with a purchase price of $116,000. Calculate the required down payment. This is simple because of what we know LTV is. LTV is the percentage you financed. So you financed 80%, which means you contributed as a borrower how much percent of your own money as a down payment? 20%. So all you had to do was take the purchase price of $116,000 and simply multiply it by 20%. And you got your answer, which is $23,200. That's your down payment. You understand how we got that? The loan is 80%. The down payment is 20%. So take the purchase price, multiply by 20%. You got the down payment as a dollar figure. B is in Bravo. Number 13, the primary purpose of an estoppel certificate is to C, verify the loan balance. (14) When a lis pendens is filed properly with the county clerk, it becomes a notification recording into public records, legal notice. 15, a couple purchased their home for $125,000. They financed the purchase with an 80% conventional loan. The lender charged 2.5 points. Calculate the cost in dollars of those points. We could use this handout. Cost in dollars. You see the trigger words they're using to help us understand what formula. Now, here's the thing you need to know. Each point is equal to 1% of the what? Loan, not the what? Sale price. But they start off by telling us the sale price is $125K, right? How do you get the actual loan? Well, they tell us the LTV, you financed 80%. So all you had to do is multiply by 80%, and you got the actual loan amount, which we needed for this calculation of $100,000. That's the loan. You understand how we got that figure? And the lender is charging 2.5 points. But we have to convert these points. It's a 1-for-1 conversion. 1 point, 1%. So if it's 2.5 points, it's 2.5% of the loan. So you simply had to multiply by 2.5%, and you got your result, which is $2,500. Is that one of your choices? Correct answer is C is in Charlie. You understand how we got this result? Any questions? Did I lose anybody? All right. We'll have another question about points, but the other calculation. 16, a borrower defaulted on a mortgage encumbering an apartment complex. Once the foreclosure proceedings were filed, the lender appealed to a court to appoint a receiver through the receivership clause. 17, the rule of thumb used to convert discount points to annual percentage rates of interest is that each point will increase the lender's yield by approximately a 1/8%. Let's apply that rule of thumb to the next question. The lender charged 7% plus 3 points. What's the approximate yield? You see the term they're using here? Very simple. 7% is your true. plus 3 points, but you have to convert them. Each point is 1/8%. I'm sorry. Oh, yeah, it's 1/8% or 0.125%. So if you were to convert it, let's take these 3 points and let's multiply it by 0.125%. And then 3 times 0.125% is going to be 0.375%. And now you simply just add, you get 7.375. You understand how we got this? 7% is your true, plus 3 points, but we converted the points. This is what we did in the parentheses. Each point is 1/8% or 0.125%. You multiplied and you got 0.375, and you just added it. So the correct answer for that reason is B as in Bravo. Any questions here? All right, 19, you have a loan with a principal and interest of $846.21. The lender requires an impound account for taxes and insurance. Taxes are $2,840, insurance is $1,570. What's your total monthly payment? This is simple, okay, because all we have to do first is add your property taxes, $2,840, to your insurance for the year, $1,570, and the total is $4,410, if I'm not mistaken. We need monthly. How do you get from annual to monthly? You divide by what? You divide by 12. Now, what do we get? When you take 4,410 divided by 12, 367.50 or 387 or 367.50, right? What is it? Don't round. Would you?
It's 367.5.
367.50. Okay. That's your tax. I'm sorry. That's your principal and interest, PI. But we need to add it to our, no, sorry, that's taxes and insurance. That's our TI. And we need to add it to our principal and interest, which they tell us within the question. It's the first thing they mention is $846.21. That's our PI. When you add those two figures together, you get your total monthly mortgage loan payment of $1,213.71. Is that right? And that equals your PITI. Are you with me on that? Correct answer is D as in Delta. Is that what you got? Correct answer is D. Now, 20, I don't have to show you the math. I can just explain it to you because it's very simple. It's basic subtraction. If your property value is $350, but you borrowed against it for $300, then what's left over? What's your equity? You got $50,000 equity. Correct answer is A as in Alpha. Any questions here? No questions? All right. You want to jump into our session for today? How you guys feel about that? Anybody need a break? Speak now. All right, let's start with Unit 13. Come on. Okay. Unit 13, we're taking a deeper dive into financing. We had an introduction yesterday. Residential mortgages. Unit 13, look at the title. Types of mortgages, sources of financing. This is so important for personal reasons to understand how money is lent. Where does the money come from? Very important to understand this, just to basically understand how the world works. And we're going to get a nice taste of that within this unit. Whole lot of key terms we're going to discuss within this unit. We're actually going to, we can start on page 296, and I'm just going to mention this to you. You don't have to highlight this. What are the typical steps towards obtaining financing? Let's just go through this together. The first step is to submit a loan what? Application. We used to call it the 1003. And now they call it the Uniform Residential Loan Application, if we're talking about residential property, which is most of the transactions you're going to be working on. The next step on page 297 is to evaluate your what? Your credit and your history, your repayment habits. Qualifying ratios, these are debt to income ratios, making sure you have enough income to satisfy the debt that you're taking on for whatever you want to buy. Qualifying the property, depending on the type of loan you're getting. We'll talk about FHA, VA loans and the requirements for that. And of course, before you can go shopping, you need what letter? You need a pre-approval letter. You'll see that in front of you. Now let's jump into it. Mortgage loans can be grouped into two general categories, conventional and non-conventional. Let's go through each one and the features for each. What's going on? Can't scroll. Is it frozen? Oh, that's why. All right, let's start with conventional loans. And we're actually going to begin with what we see on line 41, conventional mortgage loan features, starting with, naturally, the whole purpose of giving you a loan is so the lender can make what off of you? Interest. This is based on your qualifications, of course. If you go to the next page, page 298, are conventional loans assumable? Can they be assumed by another borrower? What does it say? It says fixed rate conventional loans usually include what clause? You remember the due on sale clause? That means if you try to transfer to another borrower, the lender says, I don't think so. The debt is due upon sale or transfer of title to somebody else, another borrower. So they're typically not assumable unless it's an ARM. You'll see what an ARM is here. If it's not fixed rate, if it's an adjustable rate mortgage, conventional mortgage loan, then yes, they are assumable. We'll come back to that. Prepayment. You could pay off as early as you like, no prepayment penalty. Down payment and PMI. This is important for us to see. The down payment that the lender wants you as a borrower to contribute of your own money is at least 20%. For conventional loans, the lender wants 20%, but I've seen conventional loans with down payments as low as 5%, sometimes even less than that if you can get some lender concessions. The lender sometimes contributes towards your down payment, or maybe the seller, if you're purchasing from a developer. Anyhow, if you're unable to contribute at least 20% as a down payment for a conventional loan, the lender is going to charge you an additional amount every single month. It's going to be added on to your monthly mortgage loan payment. It's called PMI. What does PMI stand for? It's right here in front of you in that paragraph. Private mortgage insurance. Insurance because you are more risky. If you're unable to contribute 20%, you're viewed as more risky. You're more likely to default in their eyes, and they make you pay for insurance to cover them just in case you default, stop paying. Do you understand how it works? You're not going to like paying it. The question I get from time to time is, does it last forever? You have to pay this throughout the entire loan term? No. After 2 years of on-time payments, good behavior, you can request to remove it. They don't make it easy for you to remove it because they love receiving that money every single month. I'm going to tell you right now. And your property has to appraise at least 21% more than what your debt is with them. So you have to have at least 21% equity in the property. You know what equity is, right? The difference between what it's worth and what you owe, at least 21%. If you have that, then they'll remove the PMI. Like I said, they don't make it easy. I could tell you personal horror stories. LTV, loan to value ratio. We just went through this, guys. What LTV do they feel comfortable with providing for conventional? LTV, 80%. So they feel comfortable lending at 80% of the purchase price. Do you see that here? You see 80%? Yeah. And if you can't, they'll charge you PMI. This is redundant. We saw that, correct? We'll come back to qualifying for conventional mortgage loans. These are debt to income ratios. We're going to come back to this calculation. It is a calculation we're going to see, and it's very useful, especially when you're working with prospective buyers that think they can afford to purchase that property that they're interested in that they found on Zillow. I'll show you how it works, and you can do a very simple calculation with them to enlighten them and put them down a correct path. On the next page, this is going to be part of your class exam. Lock it in. Okay, on page 300, we see common types of mortgages. The two most common types of conventional mortgage loans are fixed rate amortized and adjustable rate mortgage loans. I think the name gives it away, right? If it's a fixed rate versus an adjustable rate. If it's fixed, that means your rate, whatever you qualify for at time of inception, remains throughout the entire loan term. Typically, people stretch the loan term over how many years? 30 years. And then a fixed rate, how does that differ from an adjustable rate? Adjustable rate could be adjusted. Does that make sense? Periodically throughout the loan term, whatever is agreed to. However, it's usually adjusted annually. And we'll talk about how that works. But you might be wondering, what does amortize mean? This is most likely going to be your repayment method as a borrower through amortization of a loan. Let me explain what amortization means if I can get your attention for just a moment. Amortization, the word means to systematically kill or deaden, and that derives from more or mort. Do you see mort within it? Mort is associated with death. What other names are associated with death and have mort within it? Okay, that's good. Until you die right now. Mortal, immortal, rigor mortis, mortar, mortician, morgue, all amor. So love and death, anyhow. Till you die, right? Anyhow, you get what I'm saying. And this is how it works. Your monthly mortgage loan payment is going to consist of at least two parts. What are the two parts? Interest paid and what? Principal paid. What's the difference between these two components? You have to know, you have to be aware of this to have a basic understanding of how things work with lending. The principal portion of your payment is the part that goes towards actually killing the debt with the lender. You understand what I'm saying? Principal is the portion you like paying. It's killing the debt. Look up here. Interest is the portion that kills you. You get it? This is the part that goes in the bank's pocket for giving you the loan to purchase that property. In the beginning of the loan term, the majority of your payment will apply towards what? Principal or interest? Can you take a guess? Yeah, the majority of the payment is going to go in the bank's pocket for giving you the loan. The lesser portion will go towards actually killing the debt. But it doesn't remain in this place. They change places over time. Principal is going to increase, and interest, the interest portion of your payment is going to decrease. You see, like a seesaw. You have a level payment plan mortgage loan. That means your monthly payment is going to remain the same. But within that payment, you got principal and interest that change places. Are you with me? Not talking about property taxes and insurance. And you'll see evidence of that on the next page, page 301. This is an example of a $200,000 mortgage at 4%, 30-year. This is a level payment plan mortgage loan, amortization schedule. When you close on a loan and the category of your loan is amortized, they're going to give you a printout amortization schedule. It's going to be like almost thick as a magazine. And it tells you month by month over 30 years how much you've, at that point, you can look at month number 12, how much you've paid towards principal, how much you've paid towards interest, how much debt you have left. Now, some people don't like this. They don't like the fact that a lot of their payment goes towards interest. So they make additional payments directly towards what? To kill down their debt. A lot of people don't know the results of that, though. They think, oh, does my payment go down? No. Does my interest rate change? No. Okay, so how does it help me? By paying additional towards principal. They take it off your loan term. So instead of 30 years, you're chipping away at that. They take it off the end. In the first 6 months, your payment remains the same. Look, always the same. Interest out of that $954.83, almost all of it, the majority of it, almost $700 is going in the bank's pocket. The lesser portion is going towards actually killing the debt of $200,000. And since this is killing $200,000, you subtract it, and that's what you're left with. That's the balance. Do you see balance? And then you repeat the process. Month number 2, you repeat the same calculation. Look, a little bit less is going in the bank's pocket. That means a little bit more is going towards actually killing the debt. Not that much, though. Less than $1 difference from month 1 to month number 2. Do you see that? Wow, you're really making strides. It's a painstaking process. You don't really start killing your debt until the end of the life of the loan. Look, last 6 months, payment's still the same. Look how much is going in the bank's pocket towards how much is killing the debt. So that's why people want to speed it up and make additional payments towards principal. And there's a calculation. I think if you make at least one additional payment directly towards principal, like a 13th payment in the year instead of 12, but apply that last payment towards principal, you're going to kill your debt by like 5 to 7 years. It's like a Gordon Ramsay thing. Not Gordon Ramsay, that's the chef. Dave Ramsey.
Let's say, wait.
That'd be pretty cool if he was giving financial advice too. All right, anyhow. Now we have adjustable rate mortgage, also known as an ARM. Why is it called an ARM? Probably going to cost you an arm and maybe even flipping a leg. It's where your interest rate could be adjusted based on a market rate. So they tie your interest rate to a market rate, kind of like a variable lease. You remember the variable lease where your rent per square foot could change based on a market rate? It's a similar concept. And you'll see here on page 302, the lender adds 2 things together to calculate your interest rate in an ARM, index and what? Let's identify those 2 things so you can understand. Index is the market rate. That's what they tie your rate to that's going to be adjusted. This is the part that's going to be adjusted. You'll see it here. It's usually tied to U.S. Treasury bonds. Have you ever heard of these? You know what Treasury securities are? It's government stock. The return on basically you're investing in the U.S. economy. And the rate of return fluctuates, goes up and down periodically. And that's what they tie it to. So if the bond rates go down, then your rate is going to be adjusted down. It's not like a variable lease where it either stays the same or goes up. This one could be adjusted up or down based on the rate that they tie it to. And typically they tie it to government stock. Anybody can invest in government stock. China, other countries, which they do. And then we come across margin. Margin is also known as spread. You'll see that in parentheses. You might be tested on that. It's the cost of doing business with the lender plus their profit, and it remains constant over the life of the loan. This is the portion that stays the same because obviously they want to make sure their profit is consistent. But the lender doesn't want to miss out on higher interest rates. So imagine if they give you a loan, but then interest rates go up right afterwards. And they're like, dang, man, I could have made more money off this borrower. But with an ARM, they could potentially make more money off that borrower because they can adjust it to the current market rate. If you get it, that's why fixed rates are more attractive, right? Because you lock it in, and then it remains for the next 30 years. So it doesn't matter if it goes up, down, whatever the case may be. Now, if rates go drastically down, people refinance to get a lower rate. I'm just helping you understand the world of lending and how it works from the perspective of a borrower. Sorry, I have somebody doing an inspection of a property today. It's normal closing costs. Has the buyer seen the property in person? That's different. Oh, they're just sending me. All right, sorry. Let's continue on. Let's go to page. Well, by the way, I want to mention something to you right here. It's at the bottom of the page. To incentivize borrowers to take advantage of an ARM, which could benefit the lender more so than the borrower, they introduce something called a teaser rate. Basically, it's to lure you in. It's a below market rate. If you see a fixed rate mortgage loan, imagine the best fixed rate that you can qualify for is 5%. You'll probably see ARMs advertised at 3% or sometimes less. You're like, wow, that's a lot better. But with the feature that it could be adjusted. So that's the risk you take. So for instance, this ARMs are typically for somebody that doesn't need a 30-year mortgage loan. Imagine how much risk over 30 years, how much it could be adjusted. And what do rates typically do? They usually go up, okay? I know recent history rates went drastically down, and who knows what's going to happen in the future. We can't call it. But there is a risk of it going up, and that's usually the trend. With an ARM, there's another feature. I just want to mention this to you. In the beginning of you getting the ARM, they might lock it, the lender might lock it in for the first 5 to 7 years. And then after that, it's going to be adjusted. So there's a locking period as well. All of it is circumstantial. It's based on the lender and what they offer, the product, loan product. Go to page 303. We see government insured. What type of program? Yes, that's the complete title. Remember this. You'll see features here. But let me mention something to you. The basic difference between conventional loans, we talked about conventional mortgage loans already, right? And the features of that, and non-conventional loans, is that conventional loans are loans that are not backed by the government. Let me repeat that. Conventional loans are loans that are not backed by the government. So if a lender gives you a conventional loan, the lender is assuming the full risk of lending money to you. That's why the qualification threshold is higher. If you want to get a conventional loan, you have to qualify a little bit. You have to have stronger qualifications than these other programs, because these programs, non-conventional loans, are loans that are backed by the what? FHA loans are backed by the government. That means there's less risk for the lender that offers this program, because they know if for whatever reason you default, the government's going to back them. It's going to protect them. Does that make sense? That's why for FHA loans, the qualification threshold is less. But it's a double-edged sword. There's tons of benefits that we're going to learn about for FHA loans. And once we go through these benefits, you're thinking, I'm going to make sure I get an FHA loan. It can only be used for a primary residence, but here's the other side of it. If it's easier to qualify for FHA versus conventional, and you submit an offer on a property, but your offer is not the only offer, you're competing against another buyer that has a conventional loan that they're bringing to the table. How is that viewed in the world of real estate? They're thinking, okay, this person who's bringing the offer with conventional financing, they're more qualified versus the person who got a pre-approval letter for FHA financing. So they might go with the conventional buyer versus the FHA buyer. Do you understand? It's not right, because money's money. But I could tell you this. If you've been around the block as long as I have in the real estate business, for FHA loans, the property is more scrutinized than when you get conventional financing. The lender doesn't care so much about the property. For FHA, the property has to qualify, just like the borrower has to qualify. And it could be something very small, but it could blow up the transaction because of these criteria that FHA requires. Isn't that interesting? It's important to hear this. Therefore, if you're working with a buyer and they could qualify for a conventional loan, maybe you kind of direct them to get FHA financing. Just saying. But if you're working with the FHA buyer, that's okay as well. You just have to make sure that you express how qualified your buyer is to the listing agent. Hey, listen, here's our offer. I know we have FHA financing, but they want to take advantage of the 3.5% down. They don't want to spend put a lot of money into the transaction and blah, blah, blah. You have to dress it up. And that's one of the features that you'll see here. If you go to page 304, interest rate is based on your qualifications. But usually interest rates for FHA loans are lower than what's offered for conventional loans. Isn't that interesting? Discount points. The lender can still charge discount points for FHA loans, just like we talked about in Unit 12. FHA loans have no due on sale clause. So therefore, they could be assumed by another borrower. Isn't that nice? If you know somebody who got an FHA loan, 2.5% for a property, and they can't afford to hold on to that property, you can offer to take over their debt. Pretty cool. Down payment. Another reason why these are attractive. I just highlighted. As low as what? But even that 3.5% can be financed.
No.
Yes. Well, it's a non-recourse debt that you don't have to repay if you live in the property for at least 5 years. Have you heard of Hometown Heroes? You ever hear this? Have you heard of down payment assistance? Have you heard of the first-time home buyer program? Yeah, so you take this class to get informed as a home buyer, and you get the certificate. And through this Hometown Heroes program, a certain amount of government money is allocated per county within the state. And they have this reserve. It gets absorbed really quick. As soon as it becomes available, everybody is trying to get down payment assistance. So you have to be the first to grab it. And they could cover up to 3.5% as a down payment towards the purchase of your primary residence. You hear what I'm saying? And that covers the 3.5%. So you can purchase a property with no money down if you get FHA financing paired with the first-time home buyers program. You understand what I'm saying? And it's residential. What's residential defined as? How many units? 4 units or less on how many acres? 10 acres or less. So you're telling me, Michael, I can use the FHA program with all these wonderful benefits, essentially maybe not contribute any money down to buy a quadruplex? Yes, as long as you live in one of the units, you can rent out the other 3. And actually, something clever about this is those other 3 units, if they're being currently rented and generating income, God bless you, that income it's producing helps you qualify for the loan. Versus your own income, just your own income, now you have the income of these other properties. They say, okay, if we buy it, we're getting that. And the lender says, okay, this helps you. Now it shows you make more income. Now you qualify even more. You understand? It's a trick. It's house hacking, home hacking, whatever they call it. Have you heard of that before? It's not obviously it's not in the textbook. I'm sharing additional information with you. There is a maximum FHA loan. There's a loan limit, and it's based on different regions of our country. It says depending on the average cost of housing in different regions of our country. You'll see that on line 23. The maximum FHA loan for Orange County might be $400,000 or $500,000 now. It used to be a lot less, but it changes. And the average home sale in Central Florida, Orange County, Florida, is different from Orange County, California. And you can imagine FHA loans you can get a higher FHA loan in Orange County, California versus here. The ceiling is higher. For FHA loans, you have mandatory mortgage insurance. It's not like conventional. Conventional, if you contribute at least 20% down, they don't charge you the PMI, private mortgage insurance. For FHA, you have to pay for mortgage insurance to protect the bank. It's mandatory. You actually have to pay for 2 policies. Not only do you have to pay for the UFMIP, which stands for Upfront Mortgage Insurance Premium, which could be stretched out. It doesn't have to be paid all at once. But in addition to that, you also have to pay an annual MIP, which could be stretched over 12 easy payments for you. How convenient. But you have to pay. And you might be curious, okay, Michael, for FHA loans, I know you have to pay for mortgage insurance. We just learned that. But does it last forever? Can you remove it like for conventional? No. FHA must remain. So if you got a 30-year FHA loan, 30 years you have to pay for this insurance. This is the requirement, unless you refinance into a conventional loan at a later point. Are you with me? Any questions? Another beautiful thing about FHA loans is closing costs can be financed. So you might be thinking, okay, well, yeah, that 3.5% down payment could be covered, but then what about all the thousands in closing costs? You can roll that into the loan. So you see how attractive FHA loans are. You can essentially buy a primary residence with no money down and no closing costs. Walk in with $0 if you know about all of these features. Did you have a question? Of course, yeah. No prepayment penalty. It's a good question. These are qualifying ratios. As I mentioned, I'm going to come back to these. I'll show you all the calculations at once. All right, here is the negative with FHA loans, the appraisal. They require an appraisal contingency for FHA. I read something that they're thinking about getting rid of that or being able to waive it. I don't know if that's available yet, but as far as I know, you're required to conduct an appraisal, and obviously the lender would, but the contingency stipulates that if it doesn't appraise for the amount that you're willing to pay for that property under contract, the seller has to be willing to come down, or you can walk with no penalty. And the seller has to agree to that. So the seller's looking like, oh my gosh, I have to sign an appraisal contingency. It's because they have FHA financing. The lender requires it. And then in addition, it's called an appraisal inspection. They scrutinize the property and they look at these minute details, a wire hanging out of the wall that doesn't have a cap on it or something, and that could hold up the entire transaction. They say, you got to fix this before we close. And then you say, okay, really? I mean, it's so small. Yes, you got to fix it. So you fix it, and then you have to schedule for them to come out. They might not have availability for the next week to make sure it's been fixed, put the cap on the wire, and it could hold up the entire closing. And they have to report it to the lender, and the lender has to clear it. It could be a mess. Let's move on. Go to page 306. We see VA loans. Loans for who? This is also a non-conventional loan, which are loans that are what? Backed by the government. Let's talk about these features. What qualifies you on line 17? Only veterans. I like this next one's interesting. Unremarried surviving spouses of veterans. You have to stay unmarried as a widow or a widower to receive benefits, military benefits, government benefits. And then also active military can apply. And it's based on how long you serve for our country. You don't have to know all the details of that, but I'm just sharing that information with you. Who can give a VA loan? Only VA-approved lenders can offer this program. You'll see that line 22. You can easily Google search VA-approved lenders. if you serve for our country or you're working with a buyer. Loan guarantee and entitlement. Let me read this out to you. It's actually lines 29 through 32. The VA establishes loan guarantee limits, referred to as the VA loan guarantee or entitlement. The entitlement is a maximum that the government guarantees a lender will be paid in the event of the borrower defaulting. That's why it's backed by the government through this partial guarantee. So FHA loans are government insured FHA loans. VA loans are government guaranteed VA loans. It's through what we see here. It's a partial guarantee that if the borrower defaults with a VA loan, the lender is going to be reimbursed. Now, I should mention something to you. Statistically speaking, it's not here in front of us. VA loans have the lowest default rate. And it kind of feeds into that understanding of the mentality behind somebody who served for our country, that never give up, always fight mentality. It applies to all aspects of life, apparently, even for financing. Go to page 307. You can get multiple VA loans is what this means, reusing entitlement. Loan limit says the removal of the loan limits does not mean that the veteran has unlimited borrowing power without a down payment. There's a lot of nuggets right there. First of all, there's not necessarily a loan limit for VA loans. If you qualify for $1 million VA loan, it's not like FHA where it's limited based on home sales within the area. And you don't have to contribute a down payment. No down payment is required for VA loans. So 100% financing is what we're describing here. Question?
Is that still only for the first home that you have, or is that just a blanket for whatever home you have, the no down payment?
You can reuse your entitlement, so you can get multiple VA loans with the same features. And the cool thing about it is,
So it was always like that.
check this out. Loan origination fee can still be charged, but no more than 1%. Something interesting here. Look what it says on line 26. VA loans do not require what? Mortgage insurance. But they charge you something called a funding fee, also known as a user fee. And they don't really describe what the purpose of the funding fee is. Can I explain it to you? All right, the funding fee is to help the government offset the cost of foreclosures. What does that sound like? Sounds like mortgage insurance, right? You pay for something to offset the risk of foreclosures. I mean, that's what insurance is. But they say, oh no, we don't charge mortgage insurance. We just charge this funding fee, which is damn near the same thing.
So I guess this is a different. The mortgage insurance. So is it attached to the policy, to the property?
Yes.
But then this funding is just goes to a general fund, is that?
Yes, it does. It does, because all veterans contribute towards this funding fee. However, here's the thing. VA loans have the lowest default rate. So that's another thing. A lot less risk. And if you have a service-connected disability, they waive the funding fee. Service-connected disability, you don't have to pay for it. Nice feature. Obviously, you don't want to have any type of injury, but there's benefits that come along with that. Closing costs can be financed. Actually, no, that's FHA. VA loans, no, they can't. They have to be paid separately outside of the loan. VA loans, you have to pay for closing costs. I mean, there's a lot of other benefits, but closing costs have to be paid separately. You can assume a VA loan, really? Even by a what? Non-veteran. So if you know somebody who's a veteran who gets a VA loan with all those wonderful features that come along with it, you can assume that from them, even if you're not of the military. It's pretty cool.
Do most of those VA loans have a due on sale clause because of that?
No due on sale clause. Remember, the fact that it's assumable means it does not have a due on sale clause. And you'll see that here. Prepayment, you can pay off as early as you like. And then I want you to highlight here figure 13.3, the difference between FHA and VA loans, just so you can see that. When we come back from our break, we're going to do some math. debt to income ratios, which is something you want to see. But for now, let's take a break. I want you guys to be back at 10:10. 10:10. Not 10:10. Stretch out, grab a snack, make a phone call, do what you got to do. See you guys in just a moment. Got about 15 minutes. Okay, camera's on. Let's continue. We're going to discuss debt to income ratios. If you went back, you've already highlighted the housing expense ratio and the total obligations ratio. That's what I want to show you. And this is the handout that I am going to provide to you. Just it's in your account, but for now, I want you to take notes. I printed it. For whatever reason, I left it in the garage. But here we go. Debt to income ratios, very simple calculation, but this is used to determine whether borrowers are qualified to obtain financing for that property that they're interested in. Now, the housing expense ratio is just to see if they have enough income to satisfy the debt of the housing expenses, principal, interest, taxes, and insurance, and potentially mortgage insurance. But then we come across total obligations ratio. As you can see, it says used to calculate borrowers' ability to pay all monthly debts, which is a little bit more important, as you can imagine, for a lender. Because they're not just going to think about if you can afford to pay for this house, the monthly mortgage loan payment. They're thinking about, can you afford that and your other debts in the month? You can give me examples of several types of debts you pay on a monthly basis, whatever shows up on a credit report, essentially. You'll see here. Let's go through each one, starting with the HER. I'll make up some numbers so we can see how it works. Let's say, this is the calculation, by the way. You start with identifying your monthly housing expenses, which include principal, interest, taxes, and insurance, plus PMI. If you're unable to contribute, how much percent is a down payment? 20%, you got it. Let me make it up. Let's say you're paying, your monthly mortgage loan payment is $2,400. All in, everything included, $2,400. And you take that and divide it by your monthly gross income, whatever you make in the month, before any expenses. Let's say you're making $8,000 a month. Is that okay?
Yep.
Do the math. Take 2,400, divide it by 8,000. Take your monthly housing expenses divided by your monthly gross income. This is how we get the percentage, the ratio. You get point what? 0.3, which this is a ratio, which is what percent? At 30%. But what does that 30% mean? If you look up here, I'll explain it to you just real quick. It means your debt is 30% of your income. But does that mean you qualify? That's why we have this chart at the bottom. This is the same thing in your textbook, but I put it all in one place for you, both calculations and the chart. You need to remember this chart. You have to know the ratios for each type of financing. You'll see here. For conventional loans, for the HER, your housing expense ratio cannot be more than 28%. So your debt cannot be more than 28% of your income if you want to qualify for conventional financing. But do we qualify for conventional based on our calculation? No, we're over. So we do not qualify for conventional at this point, at this moment. It's not the end of the story just yet. For FHA, we have to be below 31%. Do we qualify? You see how it's easier to qualify for FHA? The qualification threshold. And VA, they don't even look at this calculation. It's not important to them. But the more important calculation, in my opinion, and lenders would obviously agree, is seeing if you can afford to cover all of your expenses in the month, not just the housing expenses. So that's called the total obligations ratio. And we take our monthly housing or our total monthly obligations, which include PITI, PMI, if you have to pay for mortgage insurance, and your long-term monthly obligations. Like what other debts show up on your credit report? Car, credit cards. That's the only debts that they're going to recognize and consider because they're looking at your credit report to determine if you qualify. Whatever appears, personal loans, medical bills, educational loans. Medical bills with a new proposal are going to be wiped off your credit report. And then student loan debt with, Biden and that administration, they try to wipe out, but it didn't, the last phase of it didn't get approved. So who knows what's going to happen with that. Anyhow, let's make it up. Let's say all your debts in the month add up to $3,200. And you're still making the same amount every single month. Let's say $8,000. Do the math. Take 3,200 and divide it by 8,000 and tell me what you get. You get 0.4, which is how much percent? 40%. Okay, you guys got the correct calculation because now we can look at this column. We can look at this column, total obligations ratio. Are we below 36% for conventional? No. So once again, we do not qualify for conventional. Our debt to income ratio is too high. But for FHA, are you below 43%? Yes. And if you're of the military and you want to get a VA loan, are you below 41%? Yes. It's not the end of the world though. This is a preliminary calculation that you can do with your buyers. And you tell them, hey, listen, give me the truth. Tell me exactly what your debts are in the month and what your true income is in the month. I'm on the same team as you. I'm coming up with a game plan for you. This is the same calculation the lender is going to do. So give me the numbers right now. And before we pull your credit and go through this entire process, let's see if you actually qualify. You see how useful this is? And then what if you find out they're not qualified for conventional, but they really want to get conventional financing? It's not the end of the world. You say, hey, listen, exactly. Can you pay off that vehicle? You have some cash saved up. Can you give a larger down payment? Because if you contribute more as a down payment, that means you have to finance less. And that means your monthly mortgage loan payment is going to be less because you don't have to finance as much. And that's how you play the game. But you have to be strategic. And this is one way to do it. Any questions here? All right, let's go back to our textbook. And on page 308 at the bottom, 308 at the bottom, we see special purpose mortgage products. Let's go through each one. Biweekly, I'll briefly describe these. Biweekly is where you pay every other week instead of every month. And how does it benefit you? This is what you need to know. Saves the borrower considerable interest and they pay off the loan sooner. How so? Well, instead of 24 half payments, look at it, says you pay 26 half payments to the equivalent of 13 full month payments instead of 12. If you pay every other week, that's how it breaks down. So you're making essentially one additional full month payment towards killing your debt within the year. Just like the trick that we talked about earlier, that strategy. Let's move on. Go to page 309, we see partially amortized. Have you ever heard of a balloon mortgage? Balloon mortgage. I use these all the time. I'm going to use it right now. I'm going to close on a property with a balloon mortgage. As an investor, I'm taking advantage. It goes hand in hand with seller financing. So the seller says, hey, listen, rather than you going to the bank, I'll finance it. I'll be your lender. But I'm not going to hold on to the debt for 30 years. I'll give you up to a certain time period, maybe 10 years, maybe 5 years. It's all negotiable. But at that 5-year mark, they call it a loan maturity date. You'll see it here, loan maturity date. They expect you to make a balloon payment, basically pay off whatever debt is owed at that point. Do you follow? A purchase money mortgage is seller financing. We actually took a note of that in a previous unit, didn't we? We said purchase money mortgage, also known as seller financing. In exchange, until you pay off the debt with the seller places a what against the property? A seller's lien, also known as a what type of lien? Starts with a V. Vendor's lien. That's what we saw in Unit 9. Do you know what a home equity loan is? We know what equity is. It's the difference between what it's worth and what you owe. If you have $200,000 in equity in your property, you could potentially, if you qualify, pull out that $200,000. They're not going to give you the full amount. They'll typically give you an 80% LTV. So you can pull up to 80% of the equity that you have in your home if you qualify for that. And people use this money for whatever they wish. Debt consolidation. They pay off cars, they pay off credit cards, and the interest rate they're getting for the home equity loan might be a lot less than 20-something% for a credit card. A new jet ski, right? They start a business or they buy other properties. But eventually you have to pay it back, right? Plus interest. You're taking out a second debt against the property. And then other people might choose to do a HELOC. Have you ever heard of a HELOC? Home equity line of credit. It's like a credit card for the equity that you have in your home. You basically spend a little bit and then you have to pay it back. Spend a little bit and you have to pay it, just like a credit card. And depending on how much you qualify for is what you have as a spending limit. Any questions here? Look what it says. LTV of both combined, typically limited to 80%. But we already mentioned that. It's on line 7. Then we come across a home equity conversion mortgage, also known as a reverse mortgage or a HECM. Okay. It's designed for people over the age of what? 62. And when an elderly person coughs, what might that sound like? HECM. It's going to help you remember. At least it helped me out when I was taking my state exam. Now, it's where if you're over the age of 62 and you have significant equity in your home, you can pull out that money in a large lump sum of cash. But when you're at that age, maybe you're retired, maybe you're on a fixed income. We're talking about SSI. What is SSI? Social Security income. But if you make too much money in the year, you don't receive this benefit. So you have to be below an income threshold to qualify for Social Security income. That's why somebody who wants to get the equity out of their house might not take a large lump sum of cash because it's going to show up as an income. It's going to wipe out their benefits. So this company that offers reverse mortgages, they give you a little bit each month to keep you under your income threshold, receive your benefits, and have this additional spending money. Something beautiful about this is it does not require repayment as long as you live in the home. Keyword live. Any questions here? And a package. If you're interested in obtaining financing to acquire both real and personal property, like you want to buy a restaurant with all the equipment inside, this is what you would look for, a package mortgage. You'll see real and personal property is what you're financing as security for the debt. Let's move on. Go to page 311. Now let's talk about something interesting. Supply of mortgage money. Where does money come from? Who lends money? The place where you originate loans is through the primary mortgage market. You see that across the top of this next page, correct? But you can obtain financing, a loan, conventional FHA, VA, from depository lenders. Here are some examples. Savings associations, commercial banks, credit unions. You asked about that previously. What are depository lenders? Can I explain it to you? Depository lenders offer banking services. Like you can open up a bank account, checking, savings there, but they also offer financing. These loan products we already talked about, like conventional FHA, VA. And those are the three examples of depository lenders that you can turn to obtain financing. How does that differ from non-depository lenders? We're talking about a mortgage lender. They don't offer banking services. You can't open up a bank account with a mortgage lender, but they offer financing. They're in the lending business. And that's all they do. They don't want to have a bank in different branches all over the state of Florida. They just want to lend money. And you'll see they primarily make FHA and VA loans. You see that? I like this chart. You can highlight this chart. It tells you their focus, what type of loans they provide typically. Let's move on. What do you need to know about non-depository lenders? Do you remember this license? MLO? We talked about it already. Mortgage loan originator, 22-hour class. You need to do this, okay? Usually I just advise, but I'm telling you, if you want to maximize as a real estate professional, especially in a down market, it gives you flexibility, because what if real estate sales slow down, but you can still operate on the lending side and help somebody pull out equity in their home? They're not getting financing to purchase because maybe the housing market is slow right now, but they want to refinance. You can still make money while real estate side is slow. And if you get your insurance license, people always need insurance and want to shop around, and you can help them with that as well. If you get those 3 licenses, you're going to put yourself in an amazing position. And when you get that license, you hang it with a mortgage brokerage company. You see mortgage broker above. All right, let's move on. We already talked about this, by the way. So I'm just going to move on to page 313. We just got done talking about the primary market, where loans are originated. What is the secondary mortgage market? It's where it's an investor market that buys and sells what? Existing mortgages. We talked about this previously. I don't know if you remember, but debts are sold. You originate a loan with whatever lender, they sell your debt. Happens time and time again in the secondary mortgage market. What's the purpose of this? Why are debts sold? This is the purpose that they give. However, I mean, it's part of the truth. It's not the whole truth. Circulates the mortgage money supply and standardized loan requirements. That's the truth. They say it's to circulate the mortgage money supply. What does that mean? That means, as a lender, imagine I'm your lender. I'm giving out 30-year mortgage loans to all of you, and I keep on doing this. Eventually, I'm going to run out of what? Money if I keep on lending out 30-year, because I have to wait 30 years to get all of what I anticipated getting, plus my profit. What if there is a more lucrative investment I could be making, but my money is tied up with all of you as my borrowers? What I can do is I can bundle my debts together and sell them in bulk to one of these 3 agencies who we're going to learn about, whose sole purpose is to buy up existing debts from lenders like myself. So I can free up my money and make the other investment at a higher rate of return. So that's how they circulate. They replenish the mortgage money supply. And also, when you qualify for a loan, it's not Chase's, BOA's, Wells Fargo's qualifications. It's not their qualifications that they require in order for you to obtain financing from them. The qualifications come from one of these 3 agencies who will buy the debt from them. Let me explain. These 3 agencies, which we'll learn about in a second, they say, if you want us to buy a debt from you so you can recoup and use that money somewhere else, then the borrower has to meet these qualifications. So the qualifications don't come from the bank, they come from these three agencies. Isn't that interesting? So what is that telling you? It's telling you that the lender is anticipating selling your debt even before they originate the loan for you. They're already planning to sell your debt because the qualifications are not from them, it's from the agency that will buy it from them. I mean, this is something that a lot of people don't know about. The book does not describe that. I'm telling you, this is how the world of lending works. It's so important for you to understand that. Who are these three agencies? Well, go to the chart. Fannie, Freddie, and Ginnie. These are not the official names. These are nicknames. Fannie sounds like a woman's name, right? But it's not a woman. It's an agency. The official name for Fannie Mae is above. Actually, it's on the previous page. It's Federal National Mortgage Association. Let's learn some facts, some features about FNMA. You can kind of see how they got Fannie Mae out of that, right? FNMA, Fannie Mae. Fannie Mae is the oldest out of three agencies. And Fannie Mae will buy up any type of existing loan. What do I mean? Look right here to the right. Buys conventional, buys government insured, and government guaranteed loans. Well, that covers all three, doesn't it? Conventional, FHA, and VA. Yes. They're publicly traded, by the way. They're in the stock market. Freddie Mac. The official name for Freddie Mac is FHLMC, which is Federal Home Loan Mortgage Corporation. Don't ask me how they got Freddie Mac out of that, but I can kind of figure it out. It's Fed, Fred, and then you got the MC, Mac, Federal Home Loan Mortgage Corporation, Fed, Fred. And you see, they buy conventional loans from small banks, credit unions, and savings associations. So that's what they primarily purchase. And then you have GNMA, Government National Mortgage Association. That's the official name, but the nickname is Ginnie Mae. And Ginnie Mae likes to buy loans that are backed by the government, and it's the only one that carries the full faith and credit guarantee of the U.S. government. It's backed by the government. It's a government agency under HUD. The other two are not government agencies. Do you see that? But this one is. And they all three of them buy up existing loans. But even outside of these three, it's an investor market, the secondary mortgage market. I've purchased notes. I've sold notes. I'm talking about a promissory note. So I originate a debt for somebody. I become their lender as the seller of the property. I did this for some lakefront properties in Lake Nona. I had these two properties. I sold them together. I offered seller financing. But then I didn't want to wait for however long it was to get what I was owed. What I did was I sold that debt in the secondary mortgage market. So even not just big agencies or big lenders are involved in this, small time, seller financing, independent notes. Let's move on. If you go to the next page at the bottom, now we can talk about federal laws regarding financing. Specifically, we're going to talk about who on line 18. Have you heard of the Fed? Do you know who the Fed is? Look on line 19. It's the Central Bank of the United States. I don't know if you've heard of this or not. The Fed is the Central Bank of the United States. Established 1913 by Congress to create a safer and more stable banking system, monetary system, money system. We live in a centralized system. And there's feelings about being in a centralized system. We used to not. It says it was established by Congress 1913. No. It was established by major bankers and tycoons of that era. There was a secret meeting, and this is true, this is documented now. Read the book. It's the Creature from Jekyll Island. The Creature of Jekyll Island, or From Jekyll Island, it's one of those. And it tells you what really happened in 1913 and the true intention behind creating the Fed. So the major bankers and tycoons of that era, they owned most of the nation's wealth already. Can you take a guess who attended this meeting? J. Pierpont Morgan. Who else? Rothschilds, Rockefellers, Trilateral Commission, just to name a few. They wanted more control of the money system. So they said, what if we create a centralized system to have ultimate control over money that exists in supply in our nation? And that's when the Fed was created. That's the genesis of the Fed. But they had to push it through Congress and get them to agree to a centralized system versus the barter system and a whole other things that we used to use. And you can imagine if you have money, you can push things through, right? And they did, and it still exists today. And this is why cryptocurrency and a decentralization of the money system is so popular. Bringing money back to the people and being able to put a value on these coins, these cryptocurrency, and being able to exchange it for goods and services versus being controlled by a centralized system. And most of the world is under the grasp of this centralized system because of the world banking system, the petrodollar, the US dollar dominance, which is struggling right now and people are trying to get away from. Think of BRICS. I don't know if you've been paying attention to what goes on in global economy. But anyhow, I'm just giving you an understanding. This is obviously not in the textbook. Today, the Fed has 3 duties: conducting the nation's monetary policy, I'll explain that, supervising, regulating banking institutions, protecting the credit rights of consumers, yeah, they're really looking out for us, and maintaining stability of the financial system. That stability that they're referring to is called monetary policy. And they use methods to stabilize our economy to make sure we're not too good or too bad for an extended time period. Too good, what happens in our economy? It's what we're going through right now. We're kind of going through like a stagflation. But yes, inflation. Too bad, we end up in a what? Recession, depression, whatever you want to call it. They change the name, hoping that we'll forget about the past and continuously spend money because we're a nation of consumers. It's what we're trained to do. That's why everybody wants to sell their products here. And that's why all these countries, when we impose tariffs, you see how they react. So we use tariffs now as leverage with the new administration. Because everybody wants to sell their products here. We are a nation of consumers. We will buy. It's how we're trained. You never sell like you sell in the United States. It's like when you put your business in Disney Springs. You understand what I'm saying? All right, whatever. Question? Nothing happens. It's the same. Your rate stays the same, your conditions, your terms, everything stays the same. It's just who owns the debt changes. Who's collecting the mortgage loan payments from you might change. The servicing company might stay the same. You remember who's servicing the loan is who's collecting your mortgage loan payments? They might keep the same servicing company because they're like, I don't want to be bothered with collecting payments from them and notifying them and all this stuff. But I own the debt. So ultimately the payments after collected go to me.
Contract can't change without your signature.
Yeah. Go to, and some people, they have problems with this. They try to use it as leverage to wipe out the debt and all kinds of stuff, but I'm not going to get into it. There was a lot of problems in 2008. This is some of the problems. What got us into trouble in 08? Look on page 316. People getting loans in other people's names because they had better qualifications. Watch, I have some homework for you, and it's entertaining homework. Watch the movie The Big Short. Okay, you got to watch The Big Short. The Big Short. 3 separate words. It's a star-studded cast. It's got Steve Carell, it's got Brad Pitt, it's got Ryan Gosling, it's got Christian Bale in it. Depression pill. Nah. It just helps you understand what led to the recession in 08 and how crazy it was. Now there's new regulations, but that's what we're going to learn about. What are the federal laws governing financing covered under the Consumer Credit Protection Act? To make sure history doesn't repeat itself, there's more strict lending requirements. More strict lending requirements. That's restricting. We start with the ECOA, Equal Credit Opportunity Act. When it comes to credit and financing, you can't discriminate for most reasons, even age. Before age, you can somewhat discriminate. We had housing for older persons, retirement communities, but for financing, you'll notice if you go to the next page under ECOA, age is included, right? You see age? There's other protected classes, but I thought that was interesting because if you're 18 and meet all the qualifications to get financing, you can't be denied because you're so young. On the other side of the spectrum, if you're 90 and want to get a 30-year mortgage loan, they can't deny you because you're so old. This is the rule. Like, are you going to be around for the next 30 years? You know, humans only live to, anyhow. The other protected classes when obtaining financing are as follows. If you're a divorcee, you can still qualify. They can't deny you. If sources of income include alimony or child support, that could be used to qualify for financing. If you don't make any income, but you make a lot in alimony or child support, that could be used as income to get a loan. Wow. Like Kim K and this guy Kanye, when they got little pop culture, okay? When they got divorced, I saw a headline that says he had to pay her $200,000 a month in child support. $200,000 a month. Does she need $200,000 a month? I mean, come on. Listen. Diddy. Now it's going to be the Kardashians. Watch. None of you caught that, right? You know what's going on with Diddy? Okay, probably Kardashians is going to be the next thing. Anyhow, I'm messing with you guys. Whatever. Lighten up. Next, we see childbearing plans. This is obviously not talking about real estate, but if you're childbearing, like you're pregnant or you have a lot of kids, you can't be denied financing because of that. And that's what we see here. These are great things, obviously. The Truth in Lending You Money Act. Yes, that's how I say it. The Truth in Lending, add this, You Money Act. You can add that. Because this is what it's all about. It's being able to know what it's truly going to cost you to obtain financing from that lender. And you'll see right here, informed use of consumer credit regulates what information is made known to the consumer when they get financing. So you're probably wondering what truths are given to us when obtaining financing, what's disclosed to us. By the way, highlight this on line 25. And you could be tested on this. This was implemented by the Fed under Regulation Z. You have to know that letter. So they might also call TILA Regulation Z. And that's why I like to call it TILA, the Godzilla. Yes, it's going to help you remember. Actually, I missed one for ECOA. If you go back to the previous page, line 18, ECOA is implemented by the Fed under regulation what letter? Regulation B, because it's all about being equal. When it comes to financing, be equal. Regulation B, be equal. And then you got Tilla the Godzilla. If you go to the next page, page 319, you'll see required credit cost disclosure under Tilla. Yes, they need to disclose APR. APR presents the annual cost of credit expressed as a rate. Do you see that? So I mentioned we would come back to it. There it is. And what else? The full cost of credit, including total cost of the loan, amount financed, total number of payments. It also protects us against bait and switch advertising. Tilla protects us against bait and switch advertising. Car companies are infamous for this. No money down, interest rates as low as 0% for the first 6 months. No. You've heard these advertisements on the radio. You've seen them on the TV, correct? If you're using triggering terms in your ads for financing, like a lender, car company offering financing, they're using triggering terms in their ads, such as what? Well, if they're including the amount or percentage of any down payment, number of payments, period, term, time, amount, dollar amounts, figures, numbers within the ad, they have to include additional disclosure. And what they usually do is they have somebody talking a million miles an hour at the end of the ad. There's no regulation on how quickly they say it, just that they do say it and include that disclosure as to why they're giving those rates. And usually, if you listen to it carefully, they say with approved beacon score of 870, like all these crazy qualifications that 99% of people don't qualify for. But they do it to bait you in, lure you in. When you get there, they say, oh, I'm sorry, you don't qualify, or it's not available, that car that you saw in the ad, but we have another car. If I can get you to provide your driver's license, we'll scan it and get you in a test drive, right? Because you're here to buy a car, right? So they bait you in, switch you for something else. This is prohibited in lending. Can't do it. If you're using those triggering terms, this is the type of disclosure that must be given. Highlight those 3 bullet points. But highlight this as well on line 26 through 28. If you're using general phrases within your ad, then you don't have to include additional disclosure. Like for instance, if you put a for sale sign in your front yard and you say 3-bedroom, 2-bath property, owner financing available, you're not giving specific financing information, so that doesn't trigger additional disclosure. And lastly, for Tilla, what do we need to know about Tilla? Highlight this. Tilla gives you the right of what? The right to do what? What does rescind mean? To cancel. Cancel financing. But not for any type of financing. Look what it says. It says, does not apply to loans to purchase or construct a house to live in, but only applies to these 3 types of financing. Home equity loans, lines of credit, second mortgages, or refis. Home improvement loans as well. What does that mean? That means if you try to get a home equity loan and you sign all the loan documents on the closing day, they don't give you the money right away. They wait how many business days to pass. It's called a cooling off period, which is how many business days? 3 business days, because you have a 3-day right of rescission, 3 days to cancel and to decide that you don't want to move forward with that type of financing. Any questions here? Let's move on to RESPA. We saw this in Unit 5, the Real Estate Keyword Settlement Procedures Act. The way that helped me remember the fact that it was implemented by the Fed under Regulation X is doing this. I like to misspell it. I call it REXPA. Regulation X. REXPA. What is it all about? Look on line 40. The law is designed to ensure that borrowers are informed regarding the amounts of types of expenses they're going to pay at the what? At the closing. At the closing. How important is it to know what closing costs are going to be before you close? If you don't bring enough to closing, what won't you do? You won't close. And if you can't close because you're not ready, willing, or able, what could you lose as a buyer? Your deposit, your $10,000 deposit as an example. So it's important to know what the costs are going to be so you can prepare for it. And we'll see that. Actually, the last time we talked about RESPA was in Unit 5 in regard to this. We don't have to highlight this again because we already highlighted it in Unit 5. It's redundant, it's repeated. In Unit 5, we talked about kickbacks, referral fees, fee splitting, unearned fees. Those are acceptable in our business. Can you split commission between you and another active licensed agent? Yes, you can. Can you give a piece of your commission to the buyer or the seller within the transaction? Yes, you can, as long as all parties are fully what? Informed or aware of what's going on here. Can you receive a kickback for referring sellers to a title company? No. For any settlement services? No. For referring business to a lawyer? No. We talked about that. Surveyors, credit reports, all this stuff. Unacceptable. But if you have a mortgage license, you could get a referral based off of that, or insurance. We talked about this already. Any questions about this? Now, both disclosures have been combined into one. It's called the TRID. Established October 3rd, 2015, but that's not a date you need to know. If you go to page 321, this is what you need to know about the TRID rule. This is what you need to know about the TRID rule. Let's go through the first class exam question. Within 3 business days of you submitting your loan application, you'll see it here on the right, the lender must send out to you something called a loan what? It's on the left. Estimate, which is an estimate of what your exact closing costs are going to be. It should fall within 10% of your exact closing costs. But you're probably curious, when do I receive my exact closing costs? At least 3 business days before the closing. And it's broken down on something called the closing what? Yeah. What helped me remember each of these for my exam was for the loan estimate, I call it the LED, loan estimate disclosure. And that creates this cool little acronym to help you remember. Think of an LED light, loan estimate disclosure. And then for the closing disclosure, we can call it the CD. You know what a CD is. You're not too young to know what a CD is, correct? You know what a compact disc is? Okay. Anyhow, it's how we used to play music in our vehicles. Now everything's Bluetooth. Anyhow, those were good old days. Keeping like the binder of CDs and flipping through it, making your own mixtapes and all this stuff. Exactly. From in the visor, having your CDs. And
When it didn't work, you're sitting there.
yeah. Being the coolest person when you create your own mixtape with the latest jams and stuff. Anyhow. Any questions here?
Closing disclosure is provided by the lender.
Yes. Yep.
Is this the same document that you review at closing?
Yeah. The closing company is going to coordinate with the lender to provide the closing disclosure because they need to get certain figures from the lender to provide the final document to you.
And they need to have that 3 days.
At least 3 business days before the closing, that has to be presented to you. It used to be 1 day. Now it's 3 business days. So if you remember in the past, like, oh, I didn't get it prior. It used to be 1 business day. This is 2015. The rule changed. So if you bought your property prior to 2015, then you might remember something different. Any questions here? Okay. Here's the thing. That's the longest unit in the textbook. I mentioned that to you yesterday. I don't want to scare you today, but we got through it. Longest unit in the textbook. Unit 5 was the second longest. So what I did was, to cut you guys a break, I combined the longest unit in the textbook, unit 13, with the shortest, which is unit 15. Unit 15 takes me 5 minutes to cover. I can almost guarantee that you're going to have maximum one question on your state exam from unit 15. Maximum. From unit 15. I don't know exactly, but I'll show you the most important parts of unit 15. Is it okay if we knock out 15? Up to you. You cool with that? We got a little bit of time. Unit 15. We can see real estate market and analysis. Sounds complicated, it's really not. It's going to be quick. And once again, I'm going to show you the most important parts, only the parts that you're going to be tested on. But let's start on the first page of this unit, page 351. You see at the bottom, physical characteristics of real estate. What's your first physical characteristic of this product that you're selling, real estate? It's not mobile. You're selling fixed property. Even if you could pick up the structure and move it to another location, can you move the land? No. The land is immobile. And that's a feature. Look, land is durable, immobile, indestructible is how they describe it. Continues actually down to line 7. And real estate is unique. There's no two properties alike. Hey, how you doing? Oh, thank you. I appreciate it. This is my wife, Diana. Thank you for dropping that off. What is this? You put some matcha in here and like a, this is a banana? All right, thank you. All right. Actually, hang out for a little bit. Okay. Yeah, you can sit down here. You can sit down in the back. You can sit down there. Thank you. All right. There's no two properties alike, right? That's why real estate appraisal is a task or service that's a little bit more difficult, because even though it's a cookie cutter home, the properties are not exactly the same 100%. We refer to this as non-homogeneity, but they use a term here, non-homogeneous. Remember that. You're going to be tested on it for your homework tonight. That means there's no two alike. Homogeneous means they're identical. But then we come across economic characteristics of real estate. And if you look specifically on line 15, who has ultimate control? The government. So I'm not lying to you. It's right here in your textbook. Wow. Do you know the relationship between supply, demand, and how that affects price? If there's a large supply of something, little demand, what happens to the price? Price goes down. Large supply, little demand. Price goes down. It's abundant. There's a lot of it available. If there is high demand, little supply, what happens to the price typically? Goes up. Can of Coca-Cola, cheap. Last Coca-Cola, ice cold, in the middle of the desert, it turns into Mad Max. You understand what I'm saying? And this is not overnight, pent up demand or supply. It's a gradual change over time. Those of us who've been in the business before housing supply was reduced to the level that it's at right now, it's very scarce, even though prices are high and so forth, everything that comes along with it, interest rates are high. That's why we're at the stagflation period. We saw beyond the horizon. We knew interest rates were not going to last at 2%. And we knew it was going to be a frenzy. So that's why we advise people. And a lot of people did not take our advice. We say, hey, listen, now's the best time to buy a property. Historic low interest rates. Buy now. If you qualify, get your tax returns in order, get a loan, buy a property. If you want to become a homeowner, now is the time. Now, a lot of people didn't listen. They got, I don't know, they got spoiled with low interest rates. But good things don't last, right? And what's the most important feature to determine value of property? Well, it comes down to 3 things. Location, location, location. Where we expect to live based on job opportunities, schools for our kids, crime, all of these things factor into our decision as to whether or not to buy a property. And the official name for this is situs, area preference. Go to page 353. Do we as consumers influence supply of housing in our market? The answer is no. We as consumers do not influence supply of housing in our market. If you look in front of us, what is supply affected by? Well, it's not us. It's not the end buyer. It's not the end consumer. It's skilled laborers, construction loans, financing, land, and materials. But we as consumers do influence what? We as consumers influence demand of housing. Demand is affected by us, the end buyer, based on something you're going to be tested on for a class exam question. Price, what we can afford, population, size of our household, our income, availability of mortgage credit, financing, and taste, preference, situs, if you remember that. Any questions here? We need to know the definition of a household unit, and your definition is right here. Highlight this paragraph, lines 8 through 10. We as consumers, what's a household unit? We actually talked about this on the first day of class. It's a dwelling space where a family can have privacy. Separate dwelling space. And for residential, we identify separate dwelling spaces of how many units? 4 units or less, exactly. Any questions about that? All right, let's move on. Go to the following page. Go to page 350. No. Yeah, go to page 354 or 355, 355. And highlight these 2 paragraphs, lines 30 through 35. We see on line 32 a what type of market versus what on line 35? A seller's market is good for who? The seller. It's not a trick, okay? Which means a buyer's market is good for who? But yes, but when does a buyer's market occur? When there's more what than what? Yes, buyer's market occurs when there's more supply than what? Demand. Now's the time to buy because you can dictate terms a little bit more favorable to you as the buyer. There's not much competition versus a seller's market when there's more what than what? More demand than supply. Then you can dictate how much you want to sell it for. And you can be picky on who you want to sell it to. And there's like what happened when interest rates were low, so much demand. People were spending $25,000 more for the property than what it was actually worth. And people were comfortable with that just because it was a tough market to be in. Any questions here? No questions? We're done with Unit 15. You didn't time me, right? About 5 minutes to cover. Okay, so I don't want to overwhelm you with longer units than that because Unit 13 is heavy. I recognize that. I want you to maximize on this opportunity. You have extra time. You're still going to get a full amount of credit, but you need to study, work on the review questions for Unit 13. 15, not as important, but specifically 13. Go through the details. You're going to be tested on it. It's going to be a big part of your exam. Any questions here? Of course. Yes, I will. I got you. Don't worry about that. And also, too, in your user account, in your student account, on your dashboard, all the handouts are there as well. And you can print out as many copies as you wish, just in case. If I give you a copy, but you're like, man, I wish I had a blank one so I can practice on it, the math and so forth, then you can print out as many as you wish. Is that okay? Any questions? Question? Yes, talk to me. Still having issues? Yes. Oh, you have his number now, right? All right, reach out to him and tell him, hey, listen, this is what's going on, and he'll be on it. We'll get it fixed. Don't worry. Of course. Take care. Have a great day. Take care, guys. Bye. I'll see you tomorrow. Be prompt. See you. I'm messing with you. Okay, fair enough. Just ask us for the link. Speak with Louis and then he'll give it to you. All right, take care. Ooh, I am hungry. And I didn't eat anything this morning. Oh, when I left. So that's a 48-hour fast. 36-hour fast. I had a smoothie, but that's not the same. It was a banana, so
I wasn't expecting to be.
one banana and peanut butter.
All at once, but then extra busy.
No.
On top of school. So I've been trying to bounce a lot.
Bingo.
No, I was saying, I had it on the bill, where it was like a huge.
Yeah. Oh, there's a new one that came out. And it allows you to track right on your camera versus using a third-party app.